commodities, I'm saying you got to be bearish commodities unless you're bearish human nature and ingenuity, because we'll always come up with more ways. Just look what the U.S. has done in the last 10 years. It's the opposite in cryptos. Not only did we obviously created this new type of assets or money, but you look at the top two, and I don't have to get them too much. There's the complete opposite when you see in commodities. In the top two, Bitcoin and Ethereum, there's definable diminishing supply.
Bloomberg Intelligence senior commodity strategist Mike McGlone is bullish on crypto assets in 2022 and beyond. Despite the increasing pressure on prices from the macro environment, the senior commodity strategist believes that the core fundamentals of the top two cryptocurrencies are enough to raise prices for a long time. In fact, McGlone says the meteoric rise he expects for the assets and the entire cryptocurrency industry is simple economics. McGlone has shared this sentiment in recent tweets and an interview with Scott Melker. In his interview, McGlone discusses the macro environment and the impact of the recent geopolitical shifts on asset prices. He especially focuses on the commodities and crypto markets, detailing exactly why investors should prefer one over the other in 2022 and beyond. In 2021, McGlone was one of the top experts that predicted that Bitcoin prices would hit $100,000. Though the crypto asset only peaked at $69,000, the Bloomberg senior strategist is still convinced about investing in the world's largest crypto asset by market cap. And it is really no surprise considering its core fundamentals compared to other assets. We will now take you to Mike McGlone's interview as he discusses cryptocurrencies, commodities, and the activities of the U.S. Federal Reserve in 2022 and beyond. Please watch the video to the end, hit the like button, and subscribe to the channel. Also, ensure you drop your comments and observations in the comments section below, as it helps with the YouTube algorithm. Thanks, and enjoy the video.
First of all, the facts are, I've been against consensus. I mean, Goldman Sachs, Morgan Stanley, Bank of America, a lot of these people are calling for much higher commodities, $150 crude oil and things like that. So it's been, I was an idiot 8 months ago, less of an idiot now. It's just the simple facts of supply, demand, elasticity versus a fixed commodity. For instance, why is the price of crude oil right now, about $86 a barrel, the same as it was in 2007? That's the first time it got to that price. And what happened in the world was what was the world's largest energy importer, the U.S., is now a net exporter. With Canada, a massive net exporter. So we used to be OPEC's best customer. Now we're a competitor. That is what's changed in the world. And that thing you always want to point out in commodities is the lessons of the Malthusians. Thomas Malthus was an economist who kind of rivaled Adam Smith in the 18th century. And he was worried that, the population is going to go too fast for production. It's the opposite. Human ingenuity will always create more stuff at a lower cost. And that's why I tilt commodities. I'm saying you got to be bearish commodities unless you're bearish human nature and ingenuity. It's the opposite in cryptos. Not only did we obviously created this new type of assets or money, but you look at the top two, and I don't have to get them too much. There's the complete opposite when you see in commodities. In the top two, Bitcoin and Ethereum, there's definable diminishing supply by code. Now, Ethereum's less by code, but Bitcoin clearly definable diminishing supply. And you look over demand and adoption, they're clearly increasing. So it's the simple rules of Adam Smith and economics that prices have to go up over time unless something shifts that trajectory negative. And I only see it increasing, adoption and demand increasing. And it's still way early days. I mean, way less than 1% of global equities are in crypto. So that's changing. So that's the big difference. The key thing to remember is don't underestimate the forces of supply, demand, elasticity to keep crude oil low and commodities low, because we can create more of it for less and we use less. And now, of course, everything's tilting towards technology. And what's part of that technology? Cryptos. And then there's the macro things for that I've been really bearish about crude oils. China's in decline. It was one of the biggest sources of demand for the last 10 years. And you dig into some of the deeper weeds, U.S. unleaded gas demand is rolling over, just like it did 2008. And supply in this kind, I'll leave you with one simple fact. In commodities, the rule is when under stress, you must always go to the cost of production. So let's look at the largest producers of the two top agriculture and energy commodities on the planet. Agriculture, it's corn. And energy, it's crude oil. In crude oil, the average cost of production in this country is about $40 a barrel, based on the data in the terminal. The price on the screen is almost double that. Okay, so what does that mean? Price is high, you're going to create more. And in corn, it's almost the same thing. So my bias all along is if you're bullish commodities, buy the producers, because they're going to make more and make money. but don't buy the actual commodity. Now, Bitcoin and Ethereum, you can actually easily buy that actual commodity, put it on your phone in storage, and never have to pay for that storage. In commodities, you still have to pay an average 5, maybe 10% storage, except for things like gold.
On Wednesday afternoon, the U.S. Federal Reserve announced its fourth consecutive 75 basis points hike, raising the federal funds rate to 3.75 to 4%. According to the central bank, recent indicators point to modest growth in spending and production. In his follow-up speech, Fed Chair Jerome Powell insisted that rate hikes and monetary tightening are still needed to address high inflation. He added that the central bank still has its eyes on the 2% inflation rate target. According to McGlone, the central bank's aggressive rate campaign is becoming very worrisome. He adds that at this rate, there is a 100% chance that the U.S. economy will slip into a recession. Here is another short clip from Mike McGlone's interview.
I view as somewhat noise, these targets and things. The key fact is that the Federal Reserve is tightening, intensifying its tightening, almost unprecedented, as financial markets drop. I mean, one thing that you could count on for almost the last 40 years is every time the S&P 500 dropped 20%, the Fed was there to save you. And they're doing the opposite now. For a key reason is they're trying to prevent financial markets from rallying. That's a quote from our chief economist. And that's why it's a perfect day to have me on. I just had my morning meeting with our Bloomberg Intelligence economics team. We're all kind of on the same page. Last year, I was one of the few who just said, don't fight the Fed. And now we're getting to that extreme case. So this is on a scale 1 to 10 that happens on a global basis for everything. The Fed is the 10, and everything else is pushed lower. Like you hear what's happening in China and GDP and everything. That's just nothing right now compared to the Fed tightening as the world tilts towards recession. Our economic team says their model says there's a 100% chance of a U.S. recession during the Biden administration. This is all tilting the other way. Even our Bloomberg yield strategist, Ira Jersey, who's been spot on with the Fed. He thinks yields are peaking, which means yields should drop as the world tilts towards recession. That's the key thing that's happening. And this is potentially, I hate to bring it up, but the fact is it's potentially bad as 1929, where we've seen the most central banks in history tightening because of lagging inflation measures, yet all the forward-looking indicators I see are collapsing. Look at housing. Let's look at it, except for one, and that's U.S. unemployment still sticky. Where too many people working. That's unfortunate, but that's just
I was going to say, we'll talk about that in a minute, but yes.
Yeah, but that's the key thing. So maybe Fed getting the 5%. What happens if and when they get there? What's going to happen to the economy? Everything you saw, the tightenings you've seen this year, haven't even trickled into the economy yet, barely. Maybe in mortgage brokers, yes, but this takes the lag. It's typically 18 months. And this is the fourth consecutive 25 basis point hike. So they're catching up to what I think is going to trigger a enduring deflationary recession, potential depression that was somewhat created because they created too much liquidity starting 2 years ago. That's just a classic, simple economic model. Virtually every bust in history has come on the back of a big boom, on the back of easy liquidity. Now, we had the easiest liquidity ever in terms of money supply, and it's all going back now. The difference, it's global. Source of demand pull from China for the last 20 years is gone. That country has gone negative. We've been pointing out this for years, but the property crisis is way overdue. Yes, there's a short-term issue with COVID, people locking up for that. And then what's the leadership doing? They're going back to the days of Mao and communists, and that pushed Chinese into poverty. And you look at Europe, no better. There's only one engine of growth on a global scale right now, the U.S., and our model is for a recession. I'm pointing out facts. And this typically at this stage, you get central banks to start adding liquidity. They're still pounding the sledgehammer.
Before the Federal Reserve announced another jumbo interest rate hike, the Biden administration announced plans to allocate $13.5 billion to help low-income households prepare for winter. With inflation still close to a 40-year high, consumers in the U.S. are paying almost 30% higher to heat their homes than they did last year. According to the central bank, job gains and modest growth in spending and production show that the economy is still strong enough to take more hikes. Here is a statement from the central bank. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The Federal Open Market Committee also stated that Russia's war against Ukraine is causing tremendous human and economic hardship and creating additional upward pressure on inflation. Unlike during previous meetings, the FOMC and Powell gave a small hint of a Fed pivot. The committee said it would consider the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments in succeeding discussions. Powell also noted that there would be a slowdown in tightening measures. According to the Fed Reserve Chairman, we could get a much-needed pivot at this coming meeting or the next. The committee is scheduled to meet in mid-December and twice during the first quarter of 2023. What are your thoughts on McGlone's interview and the latest rate hike announcement from the Federal Reserve? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.